Welcome to 10-Minute Finance. This is what school never taught you about money. And it only takes 10 minutes. What if I told you that keeping extra cash in your everyday checking account, the thing your parents told you is responsible, is actually one of the most dangerous financial habits you can have? After reading over 150 books on money, from Benjamin Graham to Ramit Sethi, I noticed the same mistake across 4 different countries: the US, Switzerland, Australia, and Canada. People are playing it safe. And that safety is quietly costing them a fortune. Today, I'll show you why. And more importantly, what to do instead. Right now, across the US, Switzerland, Australia, and Canada, trillions of dollars, equivalent, sit in low-yield bank accounts and transaction deposits, earning little to no interest. In the US, household checkable deposits and currency exceed $5.9 trillion. In Switzerland, large amounts of sight and savings deposits earn near zero rates, policy rate at 0%. In Australia, households hold hundreds of billions of AUD in currency and transferable deposits. In Canada, substantial household deposits remain in relatively low return accounts. That's not safety. That's a slow leak. Millions of people feel responsible, but they're losing purchasing power every single year. And they don't even feel it. Reason 1. The lazy worker metaphor. Let me give you a metaphor I learned from a book called The Richest Man in Babylon. Imagine you run a small business. You hire 2 workers. One works 40 hours a week. The other just sleeps in the corner. Who do you fire? Now look at your money. You worked hard, maybe 50 hours a week, to earn $10,000. But then, your cash just sits there, like the sleeping worker. Let's do quick math. Cash after 10 years, at 0% interest, still $10,000. But inflation eats 2 to 3% yearly. So it's worth less than $7,400 to $8,200 in real terms. Invested at 7 to 8% in index funds. Roughly $19,700 to $21,600. That $11,000 plus difference isn't greed. It's the cost of hiring lazy cash. Reason 2. The emergency fund trap. I know what you're thinking. But what about emergencies? I read this in The Simple Path to Wealth. An emergency fund is not your entire life savings. It's 3 to 9 months of core expenses. Rent, utilities, food, insurance. Not your takeout budget. Not your travel fund. I've met people in Toronto and Sydney with $50,000 to $70,000 in cash, terrified. But their real expenses were only $4,000 a month. That means $30,000 plus was fear money. Earning nothing. Rule I follow. Everything above 9 months of core costs is just losing value. Move it. Reason 3. Spending psychology. Here's something I learned the hard way. Not from a degree, but from a book called Your Money or Your Life. When you see $15,000 in your checking account, your brain whispers, "You're rich. Buy the espresso machine. Upgrade the flight. I once switched banks for a bonus. Forgot to re-automate my savings. Suddenly, my checking account looked huge. My spending jumped 22% in 2 months. Same income. Same life. Just more visible cash. Solution? Out of sight, out of mind. Automate investments the day your paycheck arrives. In the US, that's a 401k. In Canada, an RRSP. In Australia, salary sacrifice into super. In Switzerland, a 3A pillar. You can't spend what you never see. Reason 4. Insurance limits. Here's something that might surprise you. If your bank fails, the government won't cover everything. US, FDIC covers $250,000 per depositor per bank. Switzerland, statutory deposit protection covers 100,000 Swiss francs per depositor per bank. Australia, FCS covers 250,000 Australian dollars per depositor per bank. Canada, CDIC covers 100,000 Canadian dollars per depositor per bank. If you have $300,000 plus in one US bank and it fails, you lose $50,000. That's not a theory. That happened in 2023 with Silicon Valley Bank. Exception: money for short-term goals. House down payment, wedding, car within 5 years. Keep it in savings. Everything else, spread across banks or invest for the long term. Reason 5. Becoming a target. This is the one most people ignore. The more cash you have visible in checking or savings, the bigger a target you become. Scams today are terrifyingly sophisticated. Let me tell you a real story. Not from a textbook, but from the news. A retired couple in Vancouver had $80,000 in their checking account. They got a call that looked like their bank's real number. The scammer said, "Fraud alert, move your money to a safe account." In under 30 minutes, the couple transferred everything. Gone. The bank couldn't reverse it, because the couple authorized it. It can happen to anyone, even millionaires. I read in The Psychology of Money. The best defense isn't intelligence. It's structure. Keep only what you need. For 1 to 2 months of spending, in checking. The rest, out of easy reach. Reason 6. The false comfort of zero risk. Here's a 6th reason. And this one took me 7 books to fully understand. People say cash is zero risk. That's a lie. Inflation is a guaranteed tax on your purchasing power. In the US, inflation averaged 3.2% over the last 20 years. In Australia, 2.7%. In Canada, 2.3%. In Switzerland, lower, but still around 1.2%. If you hold $50,000 in cash for 10 years at 2% inflation, you lose nearly $10,000 in buying power. That's a guaranteed loss. No stock market crash needed. The risk isn't volatility. The risk is slow, silent, and certain. Zero risk doesn't exist. You're just choosing which risk to take. Reason 7. Opportunity cost of not compounding early. Reason 7 comes from a quote I memorized from The Millionaire Next Door. Every year you leave cash idle, you lose something you can never get back: time in the market. Let me show you. 2 people. Alex invests $10,000 at age 25 and never adds another dollar. Bailey keeps $10,000 in cash until age 35, then invests $10,000 by age 65 at 7% returns. Alex has roughly $150,000. Bailey has roughly $76,000. Same money, different decade. Alex did nothing special. Just didn't let cash be lazy for 10 years. That $73,000 difference is the delay penalty. And it's brutal. Reason 8. The mental weight of too much cash. The 8th reason isn't even financial. It's emotional. I read this in Die with Zero. Having too much cash makes you more anxious, not less. Because cash feels fragile. Every news headline, inflation, bank failures, recession, makes you wonder if you should move it. Invested properly, you stop checking the news. You stop second-guessing. You build what books call psychological equity. The quiet confidence that your money is working while you sleep. Too much cash isn't peace of mind. It's a different kind of worry. And that worry costs you sleep, focus, and joy. Reason 9. Missing out on free money, employer match, and tax refunds. And this one hurts the most, because it's completely avoidable. In the US, Canada, Australia, and Switzerland, leaving cash idle often means leaving free money on the table. Employer 401k or super matches. That's a 50 to 100% return, instantly. Tax refunds from RRSP or 3A contributions. That's cash the government sends you, just for investing. But if your money is sitting in checking, you can't take advantage of any of that. I've met people in Chicago and Zurich, leaving $3,000 to $5,000 per year in unclaimed matches and refunds. That's not conservative. That's throwing away guaranteed returns. Cash doesn't just lose to inflation. It also says no thanks to free money. The takeaway here isn't to panic, it's to be intentional. Here are 3 steps you can take this week. No finance degree required. Step 1. Calculate your real emergency fund. Add up 6 months of core expenses only. Rent, utilities, groceries, insurance. Put that in a high-yield savings account. 3 to 4% if available. In Switzerland, that's harder. So a liquid money market fund works. Step 2. Short-term goals, under 5 years. House, wedding, car. Keep those in savings or fixed-term deposits. Don't invest that in stocks. Step 3. Long-term wealth, over 5 years. In the US, VTI or VO. Canada, VCN. Australia, A200 or VS. Switzerland, CHSPI or VTX. Use tax-advantaged accounts first. Roth IRA. TFSA. Superannuation. 3A. That's it. 3 steps. No complexity. Look, I don't have a fancy finance degree on my wall, but I've read hundreds of books, made my own expensive mistakes, and fixed them. And I share everything here. If you want weekly videos on managing money without guilt or intimidation, make sure you're subscribed. No pressure. No shame. Just small, smart changes. Thanks for watching. See you next time.